Tesla Inc. TSLA is up 22% yesterday to $260 a share, down slightly in the pre-market, only 1.6%, but they had a massive day yesterday because of their Q3 earnings. We're going to quickly go through these, then take it to my automated stock valuation spreadsheet to see if Tesla is a buy or a sell. So let's have a look at these earnings. So what we have here is we have the Q3 23 for Q1 2024, Q2, and Q3. So we'll look at the last few numbers here. But let me zoom out just one tick here. There you go. So if we're looking at the revenues and automated sales up to 20 billion, that's up year on year of 2%, all-time highs. Energy generation down slightly from the prior quarter, 2.3 billion, and other revenue all-time highs as well, 2.8. So that brings up the total revenues up year over year 8%. Down slightly from the prior quarter, but you can see it is trending in the right direction. Then we have total gross profit that is up slightly, operating expenses down, adjusted EBITDA up. This is the profit here, net income attributable to common shareholders up 2.1 billion and 2.5. So this is all-time profits. And then we're looking at the capex and operating activities. So net cash flow provided by operating activities up to 6.2 billion. Capex is up as well, 3.5. But in terms of free cash flow, all-time highs of 2.7. So this is why the market has reacted pretty favorably to these. And now let's have a look at my automated sheet. So what we'll do is we'll put in the ticker Tesla, TSLA, and what this will do is it will load all the company financial data, but what we'll do is we'll put in some manual overrides here for these latest numbers. So what we can do is add in the current quarter. The total revenue, I believe, was 25. I've got this on another screen, by the way. 25 billion. You can see here that updates the revenue. Profit, as we said before, was 2.5. Cash operating activities 655, and of course capex was 3.5, meaning that the free cash flow. Oh, okay, I manually updated the sheet, but anyway, the free cash flow was 2.7 billion. So you can see all these rows have added up. Let's have a look. Market cap 816 billion, P of 73. Market is obviously a lot lower than this with 29. Earnings per share $3.56. A beta of 2.2. Very volatile stock. Target price of $210 a share. So not a buy according to analysts. Let's have a look at those revenue numbers. This is the revenue going back to 2011. Exponential growth, but slow growth. Relatively almost flat in the trailing 12 months compared to 2023, 97.17, but is all-time highs. But yes, not as much growth as the prior years. Net income not as profitable, 7.28, actually back down to sort of 2021-22 numbers where it jumped up massively and has dropped down. Free cash flow though, 4.3 billion. You can see here it had all-time highs in 2022, down in 2023, and then down slightly in the trailing 12 months. But if we look at operating income versus capex, you can see capex is up massively, but operating income is as well, just shy of all-time highs, which is why the market does like this. Shares outstanding does have some splits in here, but you can see they are issuing shares. The numbers are going up, and then there's a split, goes up again, and goes up again. So they are using this money to reinvest in the business, hopefully, but yeah, they're issuing more shares, diluting shareholders. So let's have a look at the discounted free cash flow model. Let me just reset some of these numbers here. And what this is a way of valuing stocks, looking at the future free cash flows and discount them to today's value. I don't think it's going to like the stock, and no, it doesn't. $14 a share on discounted free cash flow model. But these numbers are a little bit conservative. So we're expecting quite high revenue estimates, 114 and 136 billion in the coming years. Let's see what analysts say in terms of revenues. They're expecting 99, 104 billion, so I think that's pretty close. Yeah, so we can extrapolate that out. Net income margins are down slightly, but we'll take an average of the last 3 years just to bring it a bit up. I think that's more of a fair estimate with 13%. And net income to free cash flow, you know what, we'll go with the most recent number, which was 60%. Still $44 a share. It does not like the stock discounted free cash flow model. We will look at the Ben Graham formula for intrinsic value. This looks at earnings per share, expected growth rates, and oops, sorry, I'm just moving that around like an idiot. And AAA bond yield, I believe, is still 4.68%. Now, the expected growth of Tesla over the next 5 years is not 1%. I think analysts are a little bit more bullish than that. Oh, wow. Okay, 2%. Okay, I wasn't expecting that. So, previous 5 years was 47%. So let me put in one of those numbers. They're expecting 30% the next year as well. So let's see how they make this a buy. If it's 2%, it's $42 today. If it continued its growth rate, it would still not be a buy, interestingly enough, according to this. If it continued the growth of the last 5 years, or the next 5 years, which would be massive, massive, crazy growth, it would still not be a buy, according to the Ben Graham formula for intrinsic value. Interesting, very interesting. So finally, we're going to look at the comparable company model. This is the way of valuing companies, looking at their similar companies of similar sizes, metrics, revenues, profits, EV to revenue, EV to EBITDA, PE, forward PE. And I think in terms of comparable companies, we will compare two sets here. What I want to do is look at Ford and GM, and then we're going to compare against some tech companies, because obviously Tesla is seen more as a tech company. And let me just see if I've got another one. What was Toyota? Is ticker symbol Toyota, NSE, TM. Now these might be in Japanese yen, this last one, so let's not look at the revenues like for like. The number may be out here. You can see here enterprise value is in the hundreds of billions and still, but we'll look at the actual numbers here. These ratios should be correct. So enterprise value, Tesla is the biggest, I believe slightly bigger than Toyota. Revenues, 97, less than Ford and GM. 5-year growth rate though, 35%, bigger than all three. EBITDA, highest. Net income, one of the highest. Profit margins, not as profitable as Toyota with 11%, but 7.5 is better than GM and Ford. Price to sales, price to book. The market averages, I believe, are 3 and 5, so a lot higher. Do not look at that zero number there, that's probably not correct. PEG, which is Peter Lynch's price to earnings growth, 6.7, highest, even higher than GM. Toyota is close to 1 with 1.5, and Ford, interestingly enough, is under 1. So now we have the metrics here, which is EV to revenue. Tesla's at the top, EV to EBITDA at the top, highest PE, and highest forward PE as well. So according to this, it is not a buy, around about $70 to $80 a share. So actually, sorry, I didn't say that, sorry, 70 on the EBITDA, 80 on the EV to EBITDA, PE 47, forward PE 50, bringing an average of around about 67, so that is quite high. So what we'll do is we'll compare it to, if I just forge this on my other screen, top S&P 500 constituents. Hopefully this is by market cap. I want the most recent one. Tesla is, it's actually a bit lower now. It's in the top 12, but Alphabet, Meta, okay, we'll compare these. So we'll compare kind of tech companies of similar sizes. We'll go with Apple. Oh, my computer crashed there, apologies. Microsoft, and do we do Nvidia? We'll do Nvidia, go on. It's part of this now. These are the kind of stocks that we're comparing it to. And I'll just go through this quickly as well. Enterprise value, these companies are a lot bigger than Tesla nowadays. And Nvidia is the second largest company in the world now. Massive, massive weight, about 7% of the S&P 500. But revenues, only higher than Nvidia, hundreds of millions. 5-year growth rate, second highest. EBITDA, lowest. Net income, lowest. Profit margins, the smallest. Look at these profit margins. Apple is the worst with 26%. Microsoft more. Nvidia with 50. Lowest price to sales, interestingly. Lowest price to book. Highest PEG. So even if we rate against these companies, the only thing where this is winning is the lowest multiple, is EV to revenue, where it's got an average of 460. But compared to these, 160, 111, and 96 brings an average of 250, but that is with that. So yeah, hard to justify the price based on these multiples, even compared to car companies, not so much, and even sort of these tech companies as well. It's still deemed overvalue, but I've always kind of been against buying Tesla, and I was saying don't buy it in 2020, and it went up 1,000%. So what do I know? But you can see here, since then, since its peak, it is down around about 36%, but since the most recent bottom is up 130% to 260. Right guys, thanks for watching. Please give a like on the video. Check out my Patreon if you're interested in the sheet. Subscribe and like and all that fun stuff, and I'll catch you guys later.